Delivering at scale across India's dense urban centers demands precise physical coordination and a tolerance for constant logistical friction. This matrix reveals the actual scope of the Swiggy ecosystem, a hyper-local engine generating over 23,000 crore in trailing revenue. The underlying corporate strategy is a strict barbell model. Management balances a mature, profitable core against a cash-burning frontier. On one side of that barbell sits the legacy food delivery operation, functioning as the company's reliable cash cow. On the other side is Instamart, the quick commerce division designed to act as the primary engine for future growth. Swiggy's long-term valuation depends entirely on this internal dynamic. It must extract profit from food delivery to subsidize a brutal war for market share in the quick commerce space. To accurately value Swiggy today, you have to look past the user interface and analyze a rigorous, continuous loop of internal capital recycling. This structural node diagram maps out Swiggy's unified platform ecosystem. The architecture rests on 5 operational pillars: food delivery, Instamart, dine-out, B2B logistics like Link, and platform subscriptions. The critical binding agent holding these together is the Swiggy One subscription. By cross-selling an established base of food delivery users directly into Instamart, Swiggy lowers its customer acquisition cost compared to operators running standalone applications. Subscribers locked into this unified model also order more frequently, pushing average revenue per user significantly higher. The unified architecture serves a precise economic function. It is a structural mechanism engineered to trap user attention and enforce unit economic advantages. Let's examine the anchor providing the capital for this ecosystem, the core food delivery segment. This market has matured into a stable duopoly, locked in an equilibrium with Swiggy's primary rival, Zomato. Within this environment, Swiggy draws revenue from 3 reliable streams: commissions from restaurant partners, delivery fees paid by consumers, and high-margin platform advertising. This dashboard shows the segment's gross order value exceeding 9,000 crore per quarter. But volume requires a path to profitability, turning focus to adjusted EBITDA. Currently, Swiggy's food delivery arm yields roughly 3% of gross order value, with margins trending upward. That 3% yield is the financial bedrock of the entire corporation. It supplies the predictable operating cash flow required to bankroll expansion elsewhere. That expansion capital flows directly into the highest stakes frontier in Indian retail, quick commerce. Unlike the settled food delivery duopoly, Instamart operates in a volatile oligopoly, fighting a multi-front war against Blinkit and Zepto. This dashboard shows Instamart expanding over 70% year-over-year, hitting 7,900 crore in gross order value. This explosive scale creates economic tension. This waterfall chart tracks contribution margin recovery, clawing from deep negative margins to roughly negative 2.5%. This upward momentum is the result of a deliberate management pivot. Swiggy abandoned customer discounting and stripped away aggressive zero-fee delivery thresholds. Management is now deploying IPO funds to expand dark store density across Tier 1 and Tier 2 cities to improve fulfillment speeds. Squeezing these fulfillment centers closer to the end consumer physically shrinks the delivery radius, which pulls down the cost to fulfill each individual order. Combining lower delivery costs with efforts to drive up the total number of items in every checkout basket flips unit economics toward profitability. Instamart is out of its reckless land grab phase. Management is executing a meticulous optimization strategy to force contribution margins above the break-even point. This balance sheet highlights Swiggy's defensive moat, showing 15,000 crore in cash. This runway faces 3 headwinds: price competition deteriorating margins, escalating labor costs and wage regulations, and a market share deficit forcing Swiggy to execute from a challenger position behind Blinkit. A deep balance sheet guarantees survival, but generating enterprise value requires offensive execution against market leaders and regulatory friction. Ultimately, Swiggy offers exposure to the scale and complexity of India's urban consumption boom. The legacy food delivery segment acts as the stabilizing force, securing the baseline with reliable, predictable operating cash flow. Meanwhile, Instamart operates as a high-growth vehicle, capturing the frontier to generate significant long-term equity value. The critical catalyst moving forward rests on management's ability to maximize dark store efficiency and drag Instamart's contribution margins into positive territory. Swiggy long ago proved it could build consumer software. The current challenge is mastering the brutal, penny-pinching unit economics of the hyper-local physical world.